If you've ever looked at a price chart and felt lost not knowing whether the market is about to trend, reverse, or range, then this video is for you. Understanding market structure is the foundation of profitable trading. It's what separates winning traders from those who constantly get stopped out. In this video, I'm going to teach you 3 powerful methods to read market structure like smart money, so you can stop guessing and start trading with confidence. When you look at a price chart, the first thing you'll notice is that price isn't just moving randomly. It follows a structure. To read market structure, there are different theories, and in this video we'll cover some of the most important ones. Let's start with the first one. According to Dow theory, the market can only move in 3 ways: uptrend, downtrend, and sideways. Let's break these down in a way that actually makes sense to you as a trader. An uptrend is when price keeps making higher highs and higher lows. Think of it like climbing a staircase. Each step higher shows that buyers are in control, pushing the market up. The logic behind this is simple. Demand outweighs supply. Buyers are willing to pay higher prices, and sellers aren't strong enough to stop them. In an uptrend, price moves in 2 phases. First, we have the impulsive move, where buyers push the market higher, creating a strong upward movement. Then comes the retracement move, a temporary pullback as traders take profits before the next leg up. A downtrend is just the opposite. It's like walking down an escalator that's going faster than you expected. Price keeps making lower highs and lower lows, meaning sellers are stronger than buyers. A downtrend follows the same structure as an uptrend, but in reverse. It consists of 2 key movements. Impulsive move, a strong drop where sellers dominate. Retracement move, a temporary pullback before price continues lower. Now, here's where most traders make mistakes. The sideways market. It's the phase where price moves between flat highs and flat lows, meaning buyers and sellers are evenly matched. This is the waiting game phase, where the market is gathering energy for the next big move. Think of it like a tug of war. Buyers pull, then sellers pull, but neither side wins. The key to trading a sideways market isn't chasing breakouts too early. It's waiting for confirmation of which side takes control. Now that you understand the 3 market movements, uptrend, downtrend, and range, there's a simple checklist you should go through every time you open your chart. Ask yourself, is the market trending up? Is the market trending down? Is the market ranging? This is your foundation. If you get this wrong, every trade decision that follows will be based on the wrong context. Let's look at an example. As you can see here, the market is trending up. So the next question is price in an impulsive move or a retracement move? This question is critical because if you know the answer, you make money. As you can see, the market is in a retracement move. That means you won't buy yet. You know buyers have already taken profits and price is temporarily pulling back. Instead, you wait for the retracement to end before looking for an entry. Now, let's look at another example. This time, the market is trending down. So the first question to ask is price in an impulsive move or a retracement move? As you can see, the market is already in an impulsive move. That means a retracement move can happen if sellers decide to take profits and exit the market. Understanding whether the market is in an uptrend or a downtrend helps you decide what type of trade to take, whether to buy or sell. But more importantly, if you can answer the question, is the market making an impulsive move or a retracement move, this will help you decide when to enter. And that brings us to the next key concept: how to identify the beginning of an impulsive move and the end of a retracement move. To do that, we need to understand support and resistance. Let's break it down next. Support is a price level where demand is strong enough to prevent price from falling further. It's where buyers step in and push the market higher. Resistance is a price level where selling pressure is strong enough to stop price from rising. It's where sellers enter and push the market lower. These levels help us identify the end of an impulsive move and the beginning of a retracement move. Now, let me give you an example. The market is in an uptrend, forming higher highs and higher lows. As price moves higher, it eventually reaches a resistance level, a zone where sellers start stepping in. At this point, traders who bought earlier begin to take profits, and new sellers enter, anticipating a reversal. At resistance, the market starts showing signs of weakness. Price slows down, candlestick wicks form, indicating rejection. This signals that the impulsive move may be ending, and a retracement move is likely to begin. Once price starts pulling back, we now focus on identifying where the retracement might end. A logical area is a previous resistance level that now acts as support. At support, buyers step back in, and the next impulsive move begins. This is where traders look for buying opportunities to rejoin the trend. Look at another chart example. The market is now in a downtrend, forming lower highs and lower lows. As price moves lower, it eventually reaches a support level where some sellers take profits and buyers attempt to push price higher. At support, the market starts showing signs of temporary relief. Price slows down, bullish rejection wicks appear. This suggests that the impulsive move may be ending and a retracement move is about to begin. As price retraces higher, we look for the next resistance level, a previous support level that may now act as resistance. Once price reaches this resistance level, it breaks above but then closes back below, forming a clear liquidity sweep. This liquidity sweep signals the end of the retracement and the start of a new impulsive move. When the market is about to stop trending, it sends us a message in the form of chart patterns. These patterns are created by shifts in buying and selling pressure, and if you can recognize them early, you can anticipate trend reversals before they happen. The four main reversal patterns we'll cover are double top, head and shoulders, triple top, double bottom, and triple bottom. Let's start with an uptrend that reverses into a downtrend with a double top pattern. The market is in a strong uptrend, forming higher highs and higher lows. Buyers are in control, and impulsive moves are stronger than retracement moves. Price makes a new high, then retraces, finding support at a higher low. Buyers step back in and push price up again. Instead of breaking above the previous high, price reaches the same resistance level but fails to go higher. This creates the second peak of the double top pattern. The fact that price fails to make a new high tells us buyers are losing strength. Sellers are stepping in earlier. The uptrend is weakening. When price breaks below the previous low, the double top is confirmed, signaling a potential downtrend. What this tells us about market structure. The market was trending up, but buyers failed twice to push higher. This shift in power marks the transition from an uptrend to a downtrend. Look at another chart example. The market is in a steady uptrend, making higher highs and higher lows. Buyers are in control, and every pullback is being bought up. Price moves up, forms a high, then retraces, finding support. The market pushes higher, forming a new higher high. But here's the problem. This breakout lacks strong momentum. Selling pressure kicks in aggressively, causing a deeper retracement. The market attempts to push higher again, but this time it struggles to break past the previous high. Instead, price stalls near the level of the left shoulder, forming the right shoulder. When price finally drops below the neckline, selling pressure takes over, confirming the reversal. A head and shoulders pattern shows that the market was trending up, but each push higher was weaker than the last. The right shoulder confirms that sellers have taken control, marking the beginning of a downtrend. Look at another chart example. The market is trending up, forming higher highs and higher lows. Price reaches a resistance level, retraces, then tests the resistance again. Buyers push price up a third time, but once again they fail to break above resistance. Price drops below the neckline, confirming the reversal. The triple top pattern shows buyers attempted to break resistance 3 times and failed. This signals seller dominance and a transition into a downtrend. Now, let's take a look at a downtrend that reverses into an uptrend. The market is in a strong downtrend, consistently making lower highs and lower lows. Selling pressure dominates, and impulsive moves are much stronger than the retracement. Price makes a new low, then retraces to form a lower high before continuing down. But this time, when price reaches support, it doesn't break lower. Price bounces off support and retraces upward again, but sellers push it back down to the same support level. Once price breaks above the neckline, buyers take control, confirming the reversal into an uptrend. A double bottom shows that sellers were in control, but buyers defended the same level twice, signaling strength. Once the neckline breaks, the market structure shifts from a downtrend to an uptrend. Look at this chart. The market is in a steady downtrend, making lower highs and lower lows. Price tests a support level and bounces, retraces, then tests it again. Sellers push prices down a third time, but once again, they fail to break lower. Price breaks above the neckline, confirming the reversal into an uptrend. A triple bottom pattern shows sellers attempted to break support 3 times and failed. This signals buyer dominance and a transition into an uptrend. So this is Dow theory, but with an important update. I've incorporated chart patterns, impulsive and retracement moves to make it more relevant to today's market conditions. If you can apply this method, you won't just understand what is happening in the market. You'll be able to determine the market direction with clarity and time your entries based on the next likely move. Instead of reacting to price movements, you'll start anticipating them, which is what separates professional traders from the rest. Now that you have a solid foundation, let's move on to the next market structure method that smart money uses, the Wyckoff method. According to Wyckoff, the price of any traded asset moves through 4 distinct phases, each revealing the intentions of smart money. Let's break down these 4 stages of the Wyckoff price cycle and how they shape market trends. Accumulation phase. In this stage, the market stops trending downward and enters a period of sideways movement we call a range market. At this point, big players start quietly accumulating buy positions. They want to enter the market at the lowest possible prices, but they can't do it all at once. If they did, the price would skyrocket before they've finished accumulating. To complete their buying, they need liquidity, which means they need sellers. To make retail traders believe the market is going lower, they trigger a false breakout to the downside. Many traders panic and sell, thinking a new downtrend is starting, but in reality this is exactly what smart money wants, a flood of sell orders that they can buy into at cheap prices. Once institutions have accumulated enough positions, they reverse the price direction, breaking out of the range to the upside and shifting into the next phase, the markup. During this period, price starts forming higher highs and higher lows, a clear sign that buyers are in control. The breakout attracts more buyers, including retail traders who missed the accumulation phase. Momentum builds up, fueled by positive sentiment, economic news, or technical breakouts. During this stage, many traders rush to buy, not realizing that the best time to enter was during accumulation, when smart money was buying at the lowest prices. After a prolonged uptrend, the market starts to slow down and move sideways again, this time forming a range at the top of the trend. At this stage, institutions start selling off their positions. Retail traders, seeing the recent uptrend, continue buying, thinking the market will keep going up. Price struggles to break higher, forming equal highs or a tight range. Why don't institutions just sell everything at once? Unlike retail traders, banks and hedge funds manage massive amounts of money. If they sold all at once, it would cause a sharp drop in price, leading to losses on their remaining positions. Instead, they exit their trades gradually, distributing their holdings to late buyers who are still optimistic about the uptrend. Just like in the accumulation phase, smart money sets traps before fully committing to the markdown phase. They might allow one last push upward, making it look like the uptrend is resuming, just enough to lure in more buyers. Then, once they've trapped enough long traders, they aggressively sell off, breaking below key support levels and accelerating the downtrend. So the market shifts in to the next phase, which is the market down. Now, let's analyze a real chart example and see how we can read market structure using the Wyckoff method. First, we have the accumulation phase. As you can see here, the market was moving sideways, indicating that buyers were accumulating positions to prepare for an upward move. But before the real breakout happens, notice what occurs at the support level, a false breakout. This false breakout is called a spring. It's a liquidity sweep designed to hunt stop losses and trap sellers who think the market is about to break down. However, instead of continuing lower, the market closes back inside the range, signaling that smart money is absorbing liquidity before the real move begins. Right after that, the market explodes upward, confirming the start of the next phase. Now we enter the markup phase. This is where buyers take full control of the market, pushing prices higher. The trend is strong, momentum builds, and traders who recognize this phase early can ride the trend with confidence. But trends don't last forever. Eventually, buyers stop pushing higher. Why? Because they start selling their positions to take profits. This leads to the distribution phase. In this phase, buyers begin to sell gradually, but instead of exiting all at once, they create liquidity traps to maximize profits. A liquidity sweep at resistance occurs, triggering stop losses and trapping new buyers who are still optimistic. The market closes back inside the range, just like in the accumulation phase, but this time, it signals that the uptrend is weakening. When the support level finally breaks, the market transitions into the final phase. Now, the markdown phase begins. With smart money out of the market, selling pressure dominates and price starts to fall. And look at what happens next. The market drops exactly as expected. By applying the Wyckoff method, you can read the market with precision. Is the market accumulating? Is the market in markup? Is the market distributing? Or is the market in markdown? If you can identify where the market is in this cycle, you'll know exactly what to do, when to enter, when to exit, and when to avoid getting trapped. Now that you understand how to read market structure like smart money, it's time to apply it to your charts.